What's funny is I also called on that day saying they'll turn everyone bullish very quickly and then hit it again.
You did. You called it. You said, you know what? If the market's going to do what everyone thinks it won't, right? And right. There it goes. Today on the pod, I have the distinct honor of welcoming 𝘾𝙀𝙎𝙏. He is the publisher of the Lead Lag Report and was probably the most outspoken predictor that the yen carry trade would ultimately blow up. He's a 5X Dow Founders Award winner, a portfolio manager, and has over 1 million followers on all platforms. Today, we're going to discuss what leading threats loom on the horizon and Michael's thoughts on asset allocation in an era of devaluation. Michael, thanks for joining us. What a couple of weeks it's been. The VIX, the fear index, the highest since, the pandemic, almost the '08, crisis. You were one of the most outspoken on the yen carry trade. You called it. You even called the bounce that we're seeing now. Can you update our viewers on where things stand today?
Funny how quickly the narrative changes, isn't it? I mean, we went from the end of the world, which I often say is the bull case, to we're going back to prior highs. That's it. The reverse carry trade came and went. Yeah. And I go back to a general truism when it comes to markets, certainly at extremes, which is that the market will do everything it can to make everybody look foolish, right? The bulls and the bears. So we had what looked like a pretty nasty scare with that reverse carry trade finally seemingly playing out, and then a fairly sizable rebound off of the lows. As I've said publicly, I suspected that would happen, but then towards the end of the month, maybe into September, there might be a higher risk for what I'm calling the main event, which is the long-awaited credit event, just like the reverse carry trade was long-awaited since I mentioned it in August of last year. That's not to say that anybody should be shorting it or anybody should be ultra bearish and take actions here and now, because if you're a true long-term investor, all this is noise, no matter how painful it might be in the near term. But this kind of price action is what you see when you're in a high volatility regime. I mean, big downs tend to be followed by big ups. Everyone starts chasing the big up, and then you have another big down again.
It is kind of incredible, though. It's almost like the market has amnesia. I mean, it's like it didn't happen. It's just, back to new all-time highs. Forget about that. Obviously, the risk still remains. How prescient is that? And do you think we're going to see another event like that anytime soon?
Well, I think to your point, it shows you just how short as a society our attention spans are, right? I mean, just think about this. Last Monday, everyone was seemingly calling for an emergency rate cut by the Fed of 75 basis points. And then 5, 6 trading days later? No, I guess not. Actually, good. Maybe we're good after all. It's like, this is just insanity. The way that people, and the way the media also plays into it, I think is insanity.
Yeah, that larger problem with the credit crisis that you kind of spoke of, it felt like that was the first domino. It felt like it was starting to tip. Everything's back to normal, but when do we get there? How soon?
Yeah, I mean, look, I always go back to path matters more than prediction. So I might have an endpoint in mind, a credit event, spread widening finally taking place. But how you get there is the challenge. Even I didn't see that it would happen. The reverse carry trade dynamic, at that very moment in time. I mean, honestly, I was being informed about it by people on X telling me I was right more than me just observing it, right? At that moment in time. Look, the thesis is not me being a perma-bear. I've just made this point that you have a disconnect between most stocks that are acting like there's default risk and credit markets, which are saying there's no default risk. One of them has to be wrong. Small caps have gone nowhere for more than a year because they're being held back by the headwind of higher for longer rates, refinancing concerns, the idea that some of these companies may not make it, the so-called zombie companies, against the bond market, which is saying there's no bankruptcy risk. By the way, while unemployment is rising, and while it looks like we may finally get into that recession camp, despite what the S&P 500 is doing, I could be totally wrong on all this, right? And if that's the case, then there's tremendous opportunity in all the laggards. I just think that given the way the sentiment has shifted again so aggressively on the bullish side, it seems like we're probably due for another surprise. So to your point, you have an initial earthquake and then you have an aftershocks.
And are you currently calling for a hard landing? The recession looked like it was all but guaranteed. Some of the data is starting to weaken. We got the PPI yesterday and now everything's okay again, but are you currently calling for a hard landing?
I don't know. I mean, I tend to look at things more from what is the market itself saying beneath the surface. So what do we know now, right? We know that clearly there is some bid that's happening in long duration treasuries. Yields are dropping, something you tend to see in advance of a recession as far as a turn. What else do we know? We know that utilities have been outperforming. We know that healthcare is showing some signs of strength. We know that consumer staples, the defensive parts of the economy are showing some relative momentum. So I look at that, I say to myself, all right, it seems like the market itself is anticipating either a slowdown and or recession, right? Whether it's soft or hard, who the hell knows, right? I think a lot of that's going to be a function of whether you have a credit event or not that ends up taking some time to play out. We also know that delinquency rates are rising as far as consumer loans, and that's hard to reverse, especially as unemployment starts to rise. So as I always say, slowly then all of a sudden. Yeah. I mean, every hard landing initially looks like a soft landing.
Until it's not.
Until it's not, right.
Yeah. Those delinquencies, as they begin to accelerate, is that going to put obviously further pressure on the Fed to begin slashing rates?
Yeah, potentially. I mean, the challenge there is, again, I go back to, this is why I think it's such an amazing cycle if you actually kind of peel it back a little bit.
Yeah.
The Fed has taken its cues from the bond market as far as the rate rise to begin with. Right? Mm-hmm. Because again, credit spreads have been so tight, the bond market's been saying there's no default risk. So you can keep on raising rates. There's no tightening of financial conditions unless default risk is rising internally in terms of the spread between junk and AAA. Mm-hmm. So now you've got delinquency rates rising at actually a pretty quick pace, but spreads are still tight. So as long as spreads are tight, I don't see why the Fed would panic, right, to sort of really cut rates, because you need to see the delinquencies manifest into bankruptcy risk from the companies that are selling products to those consumers, which are increasingly going more and more delinquent. So it's really more a question of sort of where's the Fed taking its cue from?
And the credit swaps, like that credit market, the spread on that is what the metric you're really focused on?
Yeah, I mean, basically the idea is that if you look at, of similar duration, you look at, poorly rated, triple C junk debt, relative to higher quality AAA, all else being equal, what defines the differential in income that you receive as the bond holder? It's the risk of that lender going bankrupt. Mm-hmm. The more likely that lender, the junk debt issuer, is likely to go bankrupt, the more yield you're going to demand to compensate for that risk of not getting your capital back. So if that spread is tight, it means, broadly speaking, lenders of capital are not worried about getting their money back from highly levered companies. Mm-hmm. My contention is that that's completely irrational and illogical given where we are in the cycle. And again, given that small caps have not really participated whatsoever, telling you that there's concern about these companies being ongoing concerns.
Do you think the Fed can just come in and save the markets? Like, assuming, we're on the edge of another event like that, given, the debt to GDP, their balance sheet still being elevated, all these things, can they just come in and start slashing rates and the market will just jam again and everything will, go back to normal? They'll kick the can down the road another 2 years, 5 years. Is that part of your thesis as well?
Yeah, sure. Listen, I mean, it's certainly possible. I wouldn't say it's probable that they would be successful, right? I mean, that's because the other thing is, the Fed is actually in a really tricky spot. If they try to front run some kind of tail event, which is the hope of the soft landing, right? That the lag of the rate hikes coincide with the lag of the rate cuts, and that they blunt each other in terms of that. The rate hike lag hurting the economy. Aside from the fact that it's an imperfect science. If they get it wrong, then they risk inflation coming back up again, right? Like, this is the issue. It's hard to sort of imagine a scenario where the Fed gets it right, because in many ways they have to react to the damage already being done, lest they end up ultimately putting more fuel to the inflation fire.
You said something earlier interesting that I really liked. Like, this is all just noise. If you're a long-term investor, all this short-term stuff is noise. Let's talk politics for a minute. Kamala is surging in the polls now. Does it matter to you? Like, do you think the markets are going to go one way or the other in a big way, whether Trump gets in for a second term or Kamala?
First of all, I think it's important to recognize from a non-political perspective that historically the market, in quotes, tends to do better under a Democrat than a Republican. It's about annualized returns like around 9.5% versus, I think, 5.5 or 6, right, versus Republican. Part of that's a little bit skewed because of the Great Depression and the 90s as far as the 100-year data. But typically, that's kind of a truism, which is a little counterintuitive because you think Republicans would be better for equities because of tax cuts, right, on that end. Now, having said that, maybe this time is different. Maybe, Harris coming in ends up resulting in an even larger explosion, even larger explosion of debt, which has all kinds of other implications as far as the government and the reserve currency status, although I think she and Trump will both spend like mad because that's what they do, independent of the party, same commonality. So I think from that perspective, you can argue you actually might want Harris in there economically, or at least stock market wise. The more interesting thing is typically from a sector perspective, certain sectors tend to do better in certain administrations than others. So usually when you have a Republican in office, it tends to, relative to other sectors, favor energy, natural resources, materials. When you have a Democrat in office, it's more tech.
Will you position yourself a little bit, one way or the other prior to November?
So in my case, I separate from my research and the lead lag report, I'm portfolio manager of 3 funds. Those funds are rules-based, so it's not based on my thinking. So it's not one of those things where I say actively, position this way or that way. I do think, irrespective of whatever happens next with Japan and a credit event in general, you're probably due for more volatility anyway. And from a positioning perspective, all that means is if you're discretionary, you probably want to lower your beta, which means your sensitivity to the broader market. You probably want to diversify more, which would include natural resources and commodities because they are not really that correlated to equities. And honestly, I think, as you know, of all the commodities right now that one can look at, the most interesting one is gold, which continues to really run in a really powerful way. That to me becomes the more interesting thing to think through, right? If you're going to position for something, you want to position ultimately for lower correlation to stocks. And that's ultimately, I think, what's the biggest driver of gold demand here and now. Do
you have some price predictions on gold? Do you like gold? Do you own it?
No, I mean, well, I don't believe in targets because targets, as you know, are moving. All right, and that's always kind of the issue. I've liked gold actually really since the latter part of last year. When I first started saying gold is sending a warning, and the warning clearly is geopolitical risk. Right, it's every time you have any whiff of something going on, either war-wise or currency volatility-wise, you can see gold moves in advance of something coming, which is why it is sending a warning. That's, by the way, consistent with gold as a risk-off play. I mean, that's not unusual, right? It's just clear that the movement is acting off of that. I think there's a lot more. I would view more from the standpoint of time as opposed to targets, right? Meaning you had a decade or so roughly of gold not going anywhere, right? For something that's supposed to be a store of value, it certainly did not store value very well, right? For a decade, right? After inflation. When you have these prolonged cycles like that, it takes a lot of time to get people really excited about it, right? And I don't see that excitement, even though gold's at new highs. People are still talking about Bitcoin and crypto, not really gold and other precious metals, which tells me that it's still probably pretty early in the cycle. Yeah,
gold's probably got to go through 2,700 or maybe even 3,000 before you get,
and for many months, right? To say like you have to kind of get people to apply recency bias to their trading or investing of gold.
I don't want to say you've been a critic of Bitcoin, but you've been cautionary at times regarding it. What's your stance now today on Bitcoin and cryptos? It got hit harder than anything. Last week it's bounced back a bit. It's just over 60K as we're talking. What are your thoughts on Bitcoin today?
Yeah, and listen, to be clear, it's not that I'm a critic of Bitcoin. I'm a critic of stupid narratives. Like when people, that's even just me criticizing the store of value narrative on gold. Like things that these are marketing terms to me. Store value is a marketing term. There's no such thing as store value. It doesn't exist because everything has tail risk. Everything has extremes, positive or negative, right? All these are just things that are more like investments because they have risk on the right side or left side of the return distribution. So I don't agree on the store value part. I don't agree with the inflation hedge point. People will then show a chart of Bitcoin. Okay, great. I can show a chart of any stock like NVIDIA and say that that's an inflation hedge. It's not. It's just an investment. I do agree that Bitcoin, like gold, and I'd argue like treasuries to some extent, are a counterparty hedge. I mean, that was the whole reason Satoshi came up with it after '08, right? It's a counterparty to the banks, right? So I do actually think Bitcoin, if I'm right about my credit event thesis one day, I think Bitcoin actually can do okay, right? Meaning it can diverge, act more risk off. It's certainly acting more like a risk on asset, clearly, right? It's you've seen probably the same charts I've seen. It correlates to 3 times the NASDAQ.
Yeah.
Like, okay, that's a store value? No, that's just a levered risk play. But correlation, this thing about correlations are there, things are correlated until they're not, right?
Yeah.
And something can break in that sense.
Yeah. So just because, it doesn't have that underlying, there isn't that leverage there. If U.S. equities are dumping or we're in a market crash and people are turning to, treasuries and gold, they're going to also look to Bitcoin. At some point, I think
it's possible. I think it's. You had brief glimpses of it during the regional banking crisis of last year, and you had a brief glimpse of it in October of last year, where they were correlating. Just small examples. I don't think it would do as well as gold.
Okay,
on a relative basis.
We're in the devaluation camp here, right? That's for us. Really, that's the only way we see. The U.S. and pretty much everybody getting out of this, right? So with respect to the U.S. dollar, the U.S. dollar index is still well above 100. It's hanging in there. When does the U.S. dollar roll over, and how is that impacting your asset allocation? Yeah,
listen, I would love to see the dollar roll over because it would be nice for international investments to work. You need to have a weak greenback for there to be a tailwind when it comes to investing in Europe and emerging markets. If you don't believe me, just look at the correlations of currency strength against the foreign international equity side, even when you hedge the currency out. So it'd be nice to see that, because it becomes a lot easier to beat U.S. markets if you're in a weaker dollar regime. What creates it is a good question, because it's nuanced, as you know. I mean, the dollar index is primarily euro. Europe is cutting rates, or has been cutting rates before us. So you have this kind of interesting dynamic with the interest rate differentials, maybe throwing off, what should be stronger relative to each other. The truth is, in order for the dollar to weaken, you need the Fed to do some aggressive cutting, right? To stop making T-bills as attractive as they are relative to foreign capital, which basically means, oddly enough, you need to have a real big decline in equities. Whereas usually a big decline in equities is dollar bullish because of the flight to safety in the dollar. This time around, it could actually be the opposite, meaning you could actually end up having, based on the Fed's response, a much weaker currency. So we'll see. I think it's complicated, to think through.
Because, U.S. equities taking a bath will guarantee rate cuts, which will put downward pressure on the dollar. Is that kind of your...
As long as credit spreads widen alongside that. Because again, I go back to the Fed ultimately cares about default risk, because that's what impacts the economy. It doesn't really care so much about the S&P, only to the extent the S&P's weakness filters through into junk debt weakness.
Mm-hmm. So medium term, I mean, like a year or 2 years from now, you're negative on the dollar. And what about long term? First
of all, I'm negative on all fiat currencies.
Yeah,
because it's like a fiat compared to a fiat is not strong versus weak. They're all weak, right? I mean, that's just so I'm with you on the debasement side of things. Can I see a situation where the dollar is meaningfully lower and has turned the tide a year from now? Yeah, sure. Unequivocally. I think we're long overdue for a cycle where the dollar is no longer the only place to be in Forex land. But having said that, I also recognize in the near term, there is a risk of a super spike in the dollar, a la this whole milkshake theory from Brent Johnson, if you're familiar with that, right?
I am.
So I think that's also possible. So it's just a question of sort of the sequence, right? You could have a spike and then a drop, but what happens sooner, earlier in that cycle, I don't think you're going to have a drop that's meaningful here. Could be wrong.
Do you have a few favorite currencies, like other than the U.S., that you like to hold?
Not that I hold them personally, but I think the Aussie dollar gets to be interesting because a lot of that's tied to China, obviously, and commodity demand. So I have been early/wrong on this, although I don't know, because China's equity markets are still holding. I mean, China's economy is still languishing and not doing well, but the equity side is actually holding, and a large part of commodity demand is ultimately driven by China economic strength, right?
Yeah.
So if the China equity markets are sensing stabilization while the economy is lagging, if the China equity side is actually discounting a better environment, then I think the Aussie dollar could be an interesting play.
Yeah, I love that early/wrong. So many guys, it's like, oh no, I've been right for 20 years. That's just early, right?
Well, so it's
at some point, no,
it's such a nuanced thing. Like this whole, being early is the same as being wrong. That's not really true. I mean, it's about how you execute, right? I mean, if you're shorting and you're early, you're screwed, right?
Totally.
If you're playing an imperfect hedge, okay, you're fine. You can wait. But I'd rather be early and wrong, slowing down, entering a storm, than late by a minute after the crash.
Going beyond asset allocation for a moment, do you have any personal financial habits that have served you well throughout your life?
I mean, it's not intended to be a personal financial habit, but fasting has certainly been a nice personal financial habit, because I'm not spending
less money on food.
On food, obviously, right? I mean, I've lost 100 pounds over the last year just from fasting, and that's obviously helped on the cash flow side. Look, I think in general, it's a broader question, right? We often think of investing, but the reality is you can't control the value of your portfolio. So what can you control? You can somewhat control what you're spending on and how much you're spending, but partially, right? Not full. Obviously, rent and all this stuff, different animal. Yeah. But from that standpoint, I think you control what you can control and accept the rest is outside of your control. And if you can control what you can control and it's around spending, then just be careful where you're spending.
Michael, where can our viewers find you?
On Substack, 𝘲lagreport.substack.com, and of course on X, Instagram, Threads, YouTube at 𝘲lagreport. And I appreciate the invite.
Appreciate you coming on, man. Take care.
Cheers.